So a very good morning and welcome to your weekly market outlook with me, Geoffrey Gishanga, educator and market analyst at Scope Markets Kenya. So as we get to this bright Monday morning, let's get to look at what are the major fundamentals that happened in the previous week. How did they affect the various markets that we are looking out for? And what are we expecting for the week starting off from today? So welcome on board everyone and walk with me as we get to look at all this data and be able to interpret all this data together. So as we start off, last week we had quite a number of major economic news. Starting off, we had the US ISM manufacturing PMIs. We had the JOLTS job openings again for the US, for the USD. Then we also had the ADP non-farm employment change. We had the weekly unemployment rate change. Then we had the Australian economic data, and the highlight of the week was the non-farm payrolls, the most anticipated non-farm payrolls, which you had on Friday, ending the week. So let's get to see how did the various news get to affect the various currencies that we've been looking out for. We also had earnings for various companies as well. So we get to see how does all these data get to affect the various currencies or probably commodities and asset classes that we are looking out for last week. So starting off, we started the week last week with with two bank holidays. We had the Canadian bank holiday. We also had the USD bank holiday. So that was on Monday. Then we get into Tuesday. That is when we saw a bit of momentum kicking into the market. So as we start off, this week's report highlights key global economic data releases, central bank commentary, labor market conditions, and corporate earnings updates. So the insights cover the US, Australia, Canada, Switzerland, and major corporations, offering a comprehensive outlook. Okay. So as we start off, we had the Canadian and USD bank holiday. So both markets experienced reduced liquidity at the start of the week due to national holidays, temporarily dampening global trading volumes. Then we saw momentum kicking back into the markets on Tuesday, now after the bank holiday. So we had the USD ISM manufacturing PMI, so the United States economic data. So the US manufacturing sector contracted for the 6th consecutive month, reflecting ongoing pressures from import tariffs. So we've seen how tariffs has brought about a lot of uncertainty across the various markets, across even global supply chains. So tariffs still hold a very huge factor in terms of the uncertainty, global uncertainty across various markets. So the PMI was 48.7, up slightly from 48 in July. And the manufacturing currently accounts for 10.2% of the US economy. Okay. So a key insight. So despite persistent weakness, demand from the artificial intelligence, that is the AI sector, is providing support, particularly in advanced technology, and semiconductor linked industries. So industries linked to artificial technology and basically technology, things like that. Then you have the JOLTS job openings that happened last week as well. So the job openings was at 7.2 million, which was a little change from June. Then the hires and separations was unchanged at 5.3 million. The quits, we had 3.2 million people quit. Then the layoffs or the discharges was at 1.8 million. So the key insight is that stability in job openings suggests labor demand remains resilient, though slower hiring momentum reflects businesses exercising caution. So there's stability in job openings, suggesting that the labor demand remains quite resilient. Those lower hiring momentum reflects businesses exercising caution. So there's a lot of caution being exercised in terms of like slower hiring. Okay. So then you have the ADP non-farm employment change. So this usually happens as a forecast for the non-farm payrolls, because usually before the non-farm payrolls, there's usually now the ADP non-farm employment change. So this one comes first. Then the non-farm payrolls follows probably a day later on. So for the ADP non-farm employment, is usually used as a projection for what do we expect for the non-farm payrolls coming that Friday. So the ADP non-farm employment change was as follows. So the private sector hiring added 54,000 jobs versus the forecasted 75,000. Then the previous month added 104,000 new jobs. The pay growth was at a positive of 4.4% year over year. The key insight is that the weaker than expected print highlights cooling in private sector hiring, especially outside of technology and healthcare. So this marks another sign of labor market deacceleration. Okay. Then you had the weekly unemployment claims. Usually happens every Thursday. So the weekly unemployment claims are as follows. The initial claims was at 237,000, a positive of 8,000 versus the previous week's 229,000. Then the 4-week moving average was at 231,000, which was showed a slight increase. Then there was insured unemployment rate at 1.3%, which is unchanged. Okay. Then we have continuing claims at 1.9 million, which is down by 4,000. Then the key insight is that the jobless claims remains historically low, underscoring a still resilient labor market despite signs of slowing momentum. So the jobless claim still remains historically low. And then from this data, you're going to see how it actually, from this data, you're going to see how it projected for the non-farm payrolls, and now how the non-farm payrolls came out. Because from what we saw on Friday, after the non-farm payrolls, we had a very weak dollar, a significantly weak dollar, because the figure that was released that day was a figure that we've not seen that figure being released for the non-farm payrolls in a very long time. So that shows a very weak dollar. From the sentiment we've seen from the ADP, that was now the projection, or probably the forecast. Then now we come to the non-farm payrolls that was released on Friday. And here are the figures. And you get to see why we're talking about a very weak dollar. So the non-farm payrolls came out as follows. Headline payrolls was at 22,000 jobs. That was way below expectations. And the previous month was at 75,000. Again, that was a drop from the other, last month was August. So for the non-farm, the recently released non-farm payrolls was 22,000. So that reflects for August. Then from the previous month, now that was July, came out at 75K. So that was 75,000. So you've seen a steady weakening dollar. And this is something to closely observe. And now from the data we got from that, NFP on Friday, now gives us more insight on what to expect from the Fed this month. So there's been insights of either cutting the rates or maintaining the rates. So from the data that we saw on Friday for the non-farm payrolls, chances are very high you might actually see the Fed getting to cut their rates this month. Okay, chances are very high. We might see the Fed getting to cut their rates this month. Coming the next FOMC meeting should be about next week. Yeah. So from the data that came out for the non-farm payrolls, chances are very high that you might actually see the Fed get to cut their rates. But let's get to it and see what you're looking at. So the headline payrolls came out at 22,000 jobs. The 3-month average was 29,000 jobs, again indicating sharp slowdown, so a very sharp decline. Now let's get to sector breakdown. We had healthcare, social assistance, leisure, and hospitality, a positive of 75,000 jobs. Then other sectors combined, a negative of 53,000 jobs. So unemployment rate was at 4.3%. That is the highest since October 2021. So for the last 4 years, this is the highest unemployment rate within the last 4 years, 4.3%. That is why you can see from even the data on the payrolls, the 22,000 jobs, that is the lowest it has been in quite a long time, and it has been on a decline from the previous month at 75,000. Now this month at 22,000. So what are we expecting now for probably? Sorry. So what are we expecting for the month coming? Now this is September. As we get into the October's NFP, what will we be expecting for these months? Non-farm. So probably anything below the current state at 22,000 will be now definitely way will be showing a very sharp decline and definitely leading to a very weaker dollar. And we saw that immediate reaction across the various markets. Dollar pairs, we saw a lot of volatility and a lot of weakening on all pairs that have the dollar as the base currency, and definitely a lot of strength on the euros, the pounds, the euro, pound, and such pairs that have the dollar as the core currency. So the key insight: employment growth is narrowly concentrated with broad-based weakness elsewhere. So this is a clear signal of softening labor market conditions. However, this is also a sign that the dollar is not doing very well currently. Okay, it's not doing very well. There's been a very steady decline, and these numbers are worrying. So that is why I mentioned that chances are very high that we might have a potential rate cut come the next FOMC meeting within this month, because the next FOMC meeting should be either on the 15th or 16th, but sometime next week within this month. Okay. So that is something to closely observe and watch out for. Okay. Then, just a second. Oh yeah, good. Then coming into the Australian economic data, we had quarterly growth of a positive of 0.6%. Then the annual growth was at a positive of 1.3%. The GDP per capita was at a positive of 0.2%, following a decline in the first quarter. So the drivers were, we had household and government consumption supported growth, while public investment declined. So the net exports contributed modestly, led by mining commodities. So the key insights we have is that the growth remains positive but subdued, raising concerns about per capita stagnation amid weaker household savings. So that is at 4.2% versus the prior 5.2%. Then you had Reserve Bank of Australia governor speaking, Governor Bullock. The policy stance remains at 3.85%. Guidance, we had the future tightening cycles might be shallower than in other advanced economies. Then the Reserve Bank of Australia remains focused on lowering inflation without causing significant damage to the labor market. Then the market impact is that it boosted investor confidence in the Australian dollar as rate differentials with the US narrowed. Okay. Then you also had the Switzerland economic data, that is the CPI. So the monthly change was at negative 0.1%. Annual inflation was at a positive of 0.2%. The key drivers for the decline, we had international holiday packages, accommodation, air transport, and private transport hire. Then increases, we had housing rentals, clothing, and footwear. Okay. The key insight, inflation remains well below the Swiss National Bank's target, underscoring Switzerland's ongoing battle with deflationary pressures. Then coming into the Canadian economic data, we had the CAD unemployment rate being released at the same time with the non-farm payrolls. So, and that usually happens about, let's say, 97% of the times. When we have the NFP, the CAD is also usually releasing the unemployment change. So the unemployment rate was as follows. So unemployment was down a negative of 66,000. So a negative 0.3%, driven by declines in part-time work. The unemployment rate was at 7.1%, which is a positive of 0.2%. Then the age breakdown, we had core-aged men, that is 25 to 54, negative of 58,000, so down 0.8%. Then core-aged women, that is 25 to 54, negative of 35,000 and down 0.5%. So the key insight we have is that Canada's labor market shows signs of cooling, particularly in the prime working age population, highlighting vulnerabilities amid slower growth. Then coming into the corporate earnings side, we had Lululemon Athletica. So the earnings per share was at $3.10 versus the expected $2.88. The revenue was $2.53 billion, slightly below the expected or the forecasted $2.54 billion. The net income was at $370.9 million. That is $3.10 per share, down from the previous $392.9 million. That is $3.15 per share year on year. Then we have the margins. So the gross margins down to 58.5%, operating margin down to 20.7%. So guidance, you have the full year earnings per share was $12.77 to $12.97 versus the expected $14.45. Then the revenue 10.8 $10.85 billion to $11 billion versus the expected $11.18 billion. Then the market reaction. So shares fell 20% after hours. So the stock is down 45% year to date. The key insights: tariffs have significantly eroded profitability, raising concerns about Lululemon's resilience in a high-cost trade environment. So we are seeing the global effect on tariffs, even across the various companies. We've seen that on economies, we've seen that on currencies, we've seen that on global supply chains in terms of commodities, imports, exports, and now we are seeing it even spill over into the corporate sector. Now, the other one we have is Salesforce. So the earnings per share adjusted was $2.9 versus the expected $2.78. Then the revenue was at $10.24 billion versus the expected $10.14 billion. The net income was at $1.89 billion. That is $1.96 per share, up from $1.43 billion. That is $1.47 per share year on year. The revenue was at a positive of 10% year on year. So the forward guidance is that Q3 earnings per share $2.84 to $2.86. That is now in line with the expectations. The full year earnings per share $11.33 to $11.37. That is slightly above consensus of about $11.31. Then the revenue outlook was at $41.1 billion to $41.3 billion. So that is consistent with the expectations. The market reaction: the stock slipped 4% in extended trading due to conservative forward guidance. Then the key insight is that strong performance this quarter was overshadowed by cautious guidance, reflecting uncertainty in enterprise IT spending trends. So coming into the conclusion, so last week's data underscores a divergent global economic landscape. So the US economy shows resilience, but with a clearly cooling labor market. Australia's growth remains sluggish, though consumer spending offers some support. Then Switzerland inflation remains subdued, bordering on deflation. Then Canada faces labor market pressures with rising unemployment. Then on the corporate front, we had Lululemon's tariff hit outlook and Salesforce cautious guidance highlight the growing challenges global companies face amid trade frictions and shifting demand. Okay, so as we get to now analyze all this data, so investors should closely monitor the upcoming U.S. Federal Reserve decisions, as well as evolving global trade and labor market dynamics, which will play a pivotal role in shaping the next phase of economic and market performance. So the next major highly anticipated Fed report is the interest rates, the monetary policy report, which will be happening sometime this month. So that is a very key report to watch out for. So as we step into the new week starting from today, so what are the fundamentals we're looking out for? We will be looking out for the USD PPI, Producer Price Index. Then that is on September 10th. On September 11th, we will be having the Euro monetary policy statement being released. That is the same day we will also be having the USD CPI, that is the consumer price index, so definitely measuring the rate of inflation. Then also we'll be having the unemployment claims. Then on September 12th, we will be having the pound GDP. Then we will be having the USD prelim consumer sentiment. Now, something to closely observe. Every week, once you have the non-farm payrolls, the following week that comes, we usually now get to see the consumer price index follow, and also the PPI, which is now the producer price index, follow. It's important to understand or learn how the sequence of these events follows each other, so that you're also well updated and well aware about the events that usually take place. So anytime when you have after we have the NFP, the first Friday of the month, the coming week usually now comes with the CPI, the consumer price index, and the PPI as well. That is the producer price index, and that is the week that we are in, starting from today. This week as well, we will be having two events, one in Nakuru and one here at the office for the FX Mastery Series. So as we get to expand our knowledge and our reach to the various regions, we would like to invite you all. Welcome, come one, come all. Welcome to these events. Let's get to gain all the knowledge that we can to be able to understand and tackle these markets. So with that, guys, I'd like to wish you all a very fresh and productive week ahead as we get to start off this day. We've started off very bright. It's a very bright day, as you can see, very bright Monday. So let's start it off very fresh and very productive. Let's have a very productive and fruitful week ahead. So thank you, everyone, and see you on the next one.